Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Well, the cost of living in the month of January increased by more than estimates. We're talking about the Consumer Price Index. We saw the headline figure up at a rate of 3.1%. That's year over year. The Street was only looking for 2.9. The core rate also topping forecast, advancing at an annual rate of 3.9%. Earlier, I spoke with Daniel Hornung. He is the Deputy Director at the White House National Security or National Economic Council. I started the conversation by asking how the White House reacted to the CPI data this morning.
Well, of course, I think the first reaction was looking at that monthly core number coming in above expectations. But I think, as you kind of go through the report, I think allowed us to take a step back and, really realize that if you look at the data, if you look at where we've been over the last 7 months or so, it's probably not the case that much about this report changes the overall trajectory of where we're going in terms of a trajectory towards lower inflation while the job market and the economy overall stay strong. So, you wouldn't expect disinflation to continue on a straight line. We've never expected it would. There were likely some, factors related to the start of the year at play here. Obviously, we saw an unusual divergence between the CPI rent and the CPI owner's equivalent rent that contributed to some of the uptick that we saw. So I think broadly speaking, doesn't change the overall trajectory, which, as I mentioned, we really do think is an upbeat one towards lower inflation.
So much of the problem has to be addressed through Fed policy. Is there anything that the administration is talking about as a way of addressing higher prices?
Sure. Well, I think it really starts with what the president has done since he's come to office. Things like passing legislation to lower prescription drug costs, to lower health care premiums, to lower clean energy costs. He's laser focused on implementing that legislation to make sure we're able to continue to deliver cost relief for American families. He's taken action where he can, where we have administrative tools to do things like go after some of the hidden junk fees that companies can use to increase prices and reduce transparency and market transparency. So he'll continue to look for actions that he can take and really be focused on doing everything in his power to lower costs for workers and for families. Yesterday,
we heard from the head of the Richmond Fed, Tom Barkin, and one of the things that he addressed was the reluctance that many American companies may be feeling to lower prices. And Mr. Barkin believes that creates then a real risk that there will be continued inflationary pressure. Now, I know over the weekend during the Super Bowl, the president had a video where he was complaining about shrinkflation, complaining about being ripped off for things like ice cream and snack foods. Is there a way that the president can use the bully pulpit to address this, or is that asking too much?
Well, I think you're absolutely right. One of the things we saw during the pandemic is that as input costs rose and supply disruptions really cascaded through the economy, we saw some companies raise prices by more than their input costs went up. And you would have kind of expected, just based on the economic theory, the margins to come down somewhat as those pandemic disruptions were behind us. In certain cases, we haven't seen that. And so, to your point, the president, I think, is very focused on calling out where he sees examples of places that margins could come down so that consumers could see relief. That can happen in a range of, we know that, those price increases can happen in a range of ways, either the traditional way that we see inflation and price increases, or through the kind of shrinkflation that the president was talking about, where the quantity comes down but the price stays the same. And so you'll see the president continue to call for companies where the margins are quite elevated still to pass some of the savings that they've seen on to consumers.
One of the things I think we can agree on that happened as a result of the pandemic with a lot of the supply supply chain disruptions, inflationary pressures simply built up. And we've been talking about the possibility maybe of seeing a little bit of disruption when it comes to a lot of the conflict around the Red Sea. Is this something that's top of mind for the administration in trying to guard against supply chain disruptions in the Red Sea area?
Sure. Well, it's obviously something that across the administration we're monitoring very closely. You've seen the Department of Transportation, the Navy, other entities across the federal government taking action where appropriate to, make it easier for goods to flow through that region. You'll see us continue to take action where it's warranted. I think, as where we sit now in terms of the impact on, overall aggregate supply in the United States, we're not seeing major disruptions to the U.S. economy, to the U.S. measured data. But as you point out, it's certainly an area of focus and one that we'll need to continue to monitor in the weeks and months ahead.
So the president is in the early stages of a presidential campaign, and I'm curious about the strategy when you get onto the campaign trail with the president and you're addressing the issue of inflation. What are the talking points that really are agreed upon?
Well, I can't comment specifically on the campaign from here, but I will say that, the president has been focused and will continue to be focused on the fact that it's been a difficult few years for the American people. The pandemic, the price increases that folks experienced due to pandemic disruptions, due to supply chain disruptions, due to Putin's war in Ukraine. Obviously, we've seen significant progress on bringing inflation down. In fact, more progress in the United States than in any of our peer countries. But the president will be very clear over the months ahead and really conveying a message that he's doing everything in his power, and he has additional legislative proposals on the table that would work to lower costs for American families, for the middle class, for American workers, and really draw a contrast with Republicans in Congress, for example, who instead of focusing on policies to lower costs for the middle class, have prioritized as their economic approach tax cuts for the wealthiest Americans and for the largest corporations. And so it's a very different set of economic priorities, and one that I think you'll hear the president talk more about in the months ahead.
We had just saw a recent survey that was sponsored by the Financial Times in which former President Trump was given kind of more trustworthiness in being able to deal with economic issues than President Biden. Is this concerning to the administration at all?
Well, one of the things we've seen in the last few months in particular is a real beginning of an uptick in consumer sentiment and consumer confidence. We saw, in one of the surveys, a 30% increase over a 2-month period. That's the largest increase in more than 30 years. So I think as we're seeing, wages now on a sustained basis outpacing prices, you're starting to see folks feel better about not just their own financial situation, but the direction of the economy as well. And if you look at some of the surveys where folks are asked questions about the president's economic policies, the policies that he's passed that go directly at lowering some of the key costs that families face, the proposals that he's put on the table to reduce the deficit by ensuring that the wealthiest Americans and the largest corporations are paying their fair share, those are overwhelmingly popular. So I think both in kind of making clear the work that has been done to get this economy going and give us one of the strongest economic recoveries of any of the advanced economies, and in talking about the president's plans to lower costs, you'll see us increasingly focused on that in the period going forward.
Daniel, thank you so much for joining us and sharing your perspective on what we learned today with consumer inflation cooling a bit less than was expected in the month of January. Daniel Hornung is the Deputy Director of the National Economic Council.
Our guest on the program live with us is Hebe Chen, market analyst at IG. So the latest CPI numbers, that will cause a little bit of a disruption in kind of the smooth flow of things in markets. However, it may give some investors who missed out on the rally, and particularly in some of the biggest technology stocks, a chance to get in at lower levels. That's buying on the dip. And it may also give investors a chance to buy into the bond market with yields up closer to 5% than they've been in the past couple of months. Your picture now of the environment at the moment, Hebe?
Well, yes, I agree. I think, the CPI in terms of number-wise is a bit disappointment, but it's, for me, what the market's movement, the reaction to that shows me that it's definitely more than that disappointment. It's definitely sort of the reality checking for that sort of overdone optimism that has been pushed market for the past 3 months. You can actually looking into sort of a reverse version that what happened from the November, the CPI is softer, the markets start to picking up. But today is more of a reverse way of that. We're seeing that the CPI is a bit of a disappointment there, and the market start to coming back to checking that whether or not that we've been sort of celebrate that too early, even just before the first cut can be confirmed. So it is a timing that we probably expect a bit of a bumpy ahead, but overall, I'm still quite positive about the yearly end outlook for the U.S. stock for 2024.
I hear what you're saying about the market's enthusiasm, but to be fair, at the December Fed meeting, I mean, even policymakers were optimistic that the worst of the inflation story was behind them. Now, maybe we're seeing a bit of a stalling in the level or the rate of disinflation. But I'm wondering what it has done to your predictions on the Fed beginning to cut interest rates. If you look at what the swaps market is indicating right now, maybe the first rate cut doesn't happen until July. Is that consistent with your thinking, or are you seeing things differently?
Well, as I said, I think the reaction in the market today, which that has already pushed up there to July, is a bit of the, I would say, a bit of the overdone for me. I still think that June is on the table because I think that before now and then, there's quite a lot of data will coming through, including the PCE by the end of this month. But also on the other hand, if you're looking at the psychological point that when the market expecting the inflation will stay there, they'll potentially to slowing down the people that were spending, they will potentially help the inflation. So I think there's a lot of uncertainty that we're saying that we will see inflation will stay high for another quarter. And that's why I still keep my door open for the June cut.
Curious about your thoughts on Australia, because you're talking to us from Melbourne, and we understand that the ASX 200 is close to an all-time high. I think it's on the 5th or 6th move on 7,600, which is pretty interesting. That's been quite a barrier. And inflation is still very high, even higher in Australia than the U.S., right?
Exactly. Yes, you're right. So RBA, the Reserve Bank of Australia, they are now the only one major central bank that still keep the door open for further hike. So in that last week's statement, they're saying that we're still not ruling out any hike, ruling out any possibility there. And as you point out, the inflation is still the highest. We're still having about 4%. What the RBA, the game they're playing is quite different to the Fed. So what RBA trying to do, they sort of quite a balancing there. On the big picture, they're saying that we still keep the door open for more hike. But on the other hand, they sort of revised down the expectation for the inflation for the next 3 and 6 months' time. So I think compared to the other central bank, the RBA, the Australia central bank, still trying to sort of playing a safe game. They're not saying that anything could happen, but they're not saying that anything could not happen. And that's the biggest picture for the Australia's central bank at this stage. But what the market is sort of taking this message more a bit of a biasly, they just want to listen to what they're trying to listen. They're saying that, okay, the inflation target will moving down for the next 3 and 6 months, which push up the Australian stocks to its all-time high at the end of January.
I think the latest economic analysis from the RBA was predicting that services inflation will remain high, and it's only expected to cool gradually. Is this primarily a function of higher labor cost, or is there more to it?
Yes, you're right. Labor cost is one of the key components. We're seeing that wage growth pick up to its highest level at the end of the fourth quarter of 2023. That's one of the things. But meanwhile, we're going to have another unemployment rate data coming through tomorrow, which was showing that the unemployment rate was picking up to 4%. And if that's the actual number, that will be the highest number in over 2 or 3 years' time. So we definitely see a bit of a softening in terms of the labor market, but it's still pretty tight.
We haven't talked too much about China over the past many days, partly because of the holiday and partly because investors just don't seem very interested in Chinese assets anymore. Do you think that continues, Hebe?
Well, yes, most likely. I think the reason that the investor seems to lose interest in Chinese market is it becomes quite a tricky one. Yes, on data point that you're seeing the Chinese stocks jumping up 5% before the Chinese New Year, but many people, including myself, believe that it's quite a bit of artificial rally, most likely pushed by the national team, as people called it. So the question is that even the China reopens next week after Chinese New Year, the big question is how many investors will still bet on that the national team will keep supporting the market sustainably, and how many people will bet on a fundamental change of the Chinese economy. And they are the biggest challenge, they are the biggest question that will remain that when the Chinese market returns in the new Year of Dragon.
And I'm wondering whether or not before then we begin to get some high frequency data on the Chinese consumer, how they've been spending during the Lunar New Year holiday. Do you have any early indications that you can share?
I do see the couple of the picture from social media that they do have a quite strong domestic traveling demand, but I also see the data showing that the outbound, the people going overseas, has dropping into the lowest level even before the pandemic. So it looks like they do have quite a big shifting in terms of consumer behavior. Will they keep supporting the domestic consumption market? I think I still have a question mark there, as we're seeing the inflation data. Actually, the deflation pace is dropping into lowest level since the financial crisis. So that's the most recent data we have. Will the Chinese New Year change the picture fundamentally? I don't think so.
So Japan and India are two other markets that have received a lot of attention of late. For investors that are kind of newbies looking at maybe deploying some capital into those markets, how do you recommend they do it?
Well, these two markets, one of the reasons why I'm seeing that these two markets sort of attract quite a lot of spotlight is partially because the investors or the capitals is sort of outflow from China, and they're now looking for the alternative to the Chinese market. The both market have their bright spot and a bit of the concern there. For the Japanese market, I think that the economy does showing some of a rebound and recovery since last year. But the thing is that I think for the Bank of Japan's policy is still getting at the very uncertainty level. They have a bit of back and forth, and I think that will be the biggest uncertainty there. For the Indian market, I think they do have quite a huge potential given the economy growth, given the population there. But how much time would be required for them to getting the same level of China? I think that's a risk that investors have to take and think about.
Yeah, I mentioned that because in the Hong Kong market here, we have ETFs that you can buy, but the bid-ask spread is pretty big because there's not that much liquidity in them. And for some investors that don't have access, for instance, to ETFs in the United States, it could be a little tricky. And by the way, we are seeing a lot of weakness in the yen. That may be mitigating some of the losses in Tokyo. The Nikkei's down, but it's only down 0.8%, outperforming today. Hebe, thank you so much for joining us. Hebe Chen, market analyst at IG. China says it opposes the European Union's proposed trade restrictions on Chinese firms. Joining us now in our studios in Hong Kong is Jenni Marsh, Bloomberg Team Leader for Greater China Eco-Gov. Well, this is interesting. Banning European companies from doing business with these three firms. It has to be approved. The EU tried this last year, but it didn't get approved. There was some pushback from some of the member states. Is the environment different now? What do we expect?
That's right. So last year, there was a reporting that this had been proposed and that the Chinese officials had given them reassurances, which sort of led to the Chinese companies being taken off of the list that would lead to trade restrictions. Now it seems three companies have made their way back onto it. And this does come sort of as tensions between China and the EU have been building. You know, Brussels has this probe into EV manufacturers, and Beijing announced an anti-dumping investigation into French brandy at the beginning of the year. So, you know, the EU and China are sort of very carefully balancing the relationship right now. And, you know, it's in danger of tipping into some kind of trade war if they don't find a way of sort of managing ties without sort of escalating the rhetoric.
Is there a report, or is there a way that the EU was able to verify and kind of, you know, put some muscle behind these accusations? Is there some type of investigation that has been conducted along these lines?
I mean, this is a proposal that Bloomberg has seen, and it's not a public document. So right now, the sort of the methodology isn't a particularly transparent process. But we do know that European officials are speaking to Chinese officials, and they seem to be acting, with sort of a degree of caution before they publish these trade restrictions. So I imagine, the various sort of exchanges we've seen at diplomatic levels and with trade representatives, this is something that's coming up, along with, assisting the European Union with its trade probes as well.
I feel that the environment is different now, and that you're definitely more in the area of a trade war than we were last year, particularly because of this, the exchange of probes here on EV manufacturers, Chinese EV manufacturers, and then China flipping around with the cognac stuff. So if it is a trade war, what does it mean comes next? I mean, is it on the order of the U.S. and China, or to a much lesser degree?
I mean, for China, the hard thing is, how do they fight back? Europe is an important trade partner, and there are areas that they could cover. They could sort of, they could target, such as sort of cosmetics, there's some agricultural products, and high-end luxury goods. But essentially, that China's quite limited in how it can respond if Europe decides to really ramp this up. China needs Europe as a market for many of its products. So, where it goes from this, we'll have to see. But it's a dangerous environment for China because, you've got Trump out there looking increasingly good on the campaign trail and threatening 60% tariffs on Chinese goods if he's elected. And then you have the EU sort of turning up the temperature around the trade deficit as well. So, it's just putting increased pressure on Beijing at a time when the economy is already under a lot of strain domestically.
So 24 firms in total, from what I understand, are on this list, including the 3 based in China. Do we know the nature of their business? And I'm curious, are any in the banking industry? Do we know?
I actually don't know too much about the specifics of the companies. I understand that they're believed to be essentially importing goods and then re-exporting them to Russia, and sort of goods that are deemed useful to Russia's military efforts. But in terms of the companies, they're not sort of brands that we would have heard of. So I think, digging into who those companies are and what their exposure is to the European market as well would be interesting.
And Hong Kong has some companies on the list too. I haven't actually seen the list of companies, and we didn't actually name them in our reporting on this. But to what degree is Hong Kong kind of involved?
Like you said, this includes firms in Hong Kong. When Hong Kong firms were exposed to this previously, I think there was some concern that they weren't actually sort of traditional sort of Hong Kong firms, that they were shell companies for other firms sort of that have an office listed in Hong Kong, but they're not sort of Chinese companies, if you like. Hong Kong is sort of famous for sort of being a base for a lot of shell companies. So it could be that, Hong Kong sort of registered companies, but actually not Chinese firms as such.
So we had the news of the proposed new trade restrictions yesterday. Beijing today pushing back and calling this plan really illegal sanctions. I'm wondering, do we have a sense of what the next step may be very quickly?
I mean, I imagine the next time we have meetings between European and Chinese officials, this is going to come up. We've already seen that Chinese officials are lobbying behind the scenes. So I imagine this is going to be like another area of discussion between the two sides when they do meet. And
when they talk about illegality, in what sort of jurisdiction? Is that in the eyes of the international community or what?
It is an interesting phrase. It's a standard Chinese phrase in how they sort of refer to the sanctions. They unilaterally oppose them.
It's terrible.
Except when China imposes them, and then it's okay.
Yeah, absolutely. Okay, Jenni, thanks very much for joining us here on the program live. Jenni Marsh, Bloomberg Team Leader for Greater China Economic and Government Material. This is Bloomberg.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.